Today's guest has spent nearly 3 decades in the markets, and he'll tell you that the job was never really about the money.
Financial advisors really meet clients at their most vulnerable. Their savings, outlooks, right? Their hopes, their dreams for retirement.
A CFA and certified planner who walked away from the big firms to build something product agnostic and client first, where the advice isn't driven by what someone upstairs needs to sell.
If your advisor only has a Series A, I now call it a Series 007. It's a license to go, right? It really is. It can be. That's not enough to me.
He's lived through every crash since the dot-com bust, and he's learned that the real enemy isn't the market, it's the panic.
And in your garage, there is a giant readout of what your house is worth. How long before you started asking yourself questions like, did something happen in my neighborhood? Is there a sinkhole? Should I move? Should I sell? What changed in your plan?
In this episode, we get into why the crowd is the most dangerous place to be, why more information makes investors more afraid, not less, and the moment that reminded him why he does this at all.
She thanks me, and I could tell she wanted to hug me, but we were in the bridge.
Boris Castillo, welcome to Lead to Scale.
Welcome to our show, Lead to Scale. This podcast is sponsored by Algo AI Partners. We help fintech services companies and businesses scale using smart AI solutions. If you want to book a free consultation to find out more, click the link in the description below. Today, we're joined by Boris, CFA and CFP, founder and wealth manager at Amenity Wealth. With nearly 3 decades in the markets and planning, he's built a product-agnostic, client-first practice that centers on clarity and real-world outcomes, not hype. Boris, welcome to the show. This was a very cursory overview of an introduction of yourself. Please do us the honors and introduce yourself.
Thank you. Thank you for having me on. Well, like you mentioned, it's been 30 years. Doesn't feel like that, but it has. During that time, not only did I get my charter to become a charter financial analyst and a certified financial planner practitioner, but really what led me on my journey was the ability to connect with people on a real basic level, a very intimate level, because outside of the attorney who, makes sure that you stay out of prison, right, or that your stuff is in order, or the doctor who has the final say, really, in terms of where we continue, financial advisors really meet clients at their most vulnerable, right? Their savings, their outlooks, right, their hopes, their dreams for retirement or for college planning or whatnot. And so you really touch on a vulnerability there, which is interesting because, the Latin term for vulnerable actually comes from wound. So for people to sit there and expose themselves there, you have to really learn a very good bedside manner to get them to open up. But, that's one of the reasons why I formed Amenity Wealth, which is we take that extra step, right? We don't just jam people into plans. And here you go. Does it make sense? If it does, great, sign it here, right? And we'll see each year. That's not the kind of journey most of the clients we deal with are looking for. Because in the final analysis, it's all about their experience, right? And if their experience isn't up to par, then they're always going to feel something off, right? So that's what we try to do here. And I think that it separates us from the myriad financial planning institutions that will come to public.
Yeah, no, I totally get that, and I can really appreciate that client first piece. I mean, it's harder to appreciate when someone says client first, and I think the lived experience of that, of witnessing what that looks like, I think just speaks volumes. And so now I'm curious. You mentioned you've been in this space for the last 30 years. I'm afraid to say let's start from the beginning, but I'm curious, how did you first get into the wealth management
Okay.
space?
My sister, my older sister, kind of prompted me into it. I got my degree in humanities with a Greek and Latin focus. My minor was finance, and I didn't think I would go into it, but this was the 90s, and the market was just growing, and pretty much there were a lot of open doors to get in, like before the dot-com bubble burst. But I'd always had an interest in it. When I was a kid, I used to bug my mom to buy Coleco stock because I had a ColecoVision, right? Everybody else had Atari. I went to the ColecoVision. But I saw that people were just going crazy trying to get these Cabbage Patch dolls that were in back order. I don't know if you remember that craze. But it was interesting because they kept telling her buy Coleco stock. She never did. But Coleco stock was one of the best stocks of that decade. But here's the interesting part. by 1989, 1990, they were bankrupt. And the stock was delisted, which kind of threw me for a loop that, a company can have that kind of volatility. And that's actually what got me into the minor. I thought for sure I was just going to go to humanities. I studied a lot of art history. They didn't offer the art history minor when I was there, but I would have gotten it because all you needed was more upper division courses. But
Mm.
that's why I got the minor in finance, because it fascinated me that how can you make all this money and then just disappear, right? I mean, now I kind of laugh at it. I lived through Enron. I lived through WorldCom. Through so many. But when you're, a teenager, it's mind-boggling that they made that much money. I could retire on that much money. What happened? So that's how I got started. And then from there, I worked. There used to be three main channels. I think for the most part, there are. There are the wirehouse channels. That title comes from back in the 20s. They had a direct line to the stock exchange. So Merrill Lynch, Goldman Sachs, all they're known as wirehouses, right? Morningstar. Then there were the banks. That's where I spent a lot of time. So all the banks have some sort of financial institutions division. They have their own investments department, and so guys like us come and we get referrals from the bank. So cost of client acquisition is next to nil, right? Uh, but one of the
Mm.
negatives is some banks kind of offer this much of a product out, right? So you're kind of jamming a lot of square pegs around holes, right? And then the third one is the independent channel, which I'm in now, right? So that's the Osaics of the world, the LPLs of the world. So you have more breathing room, right? But you're kind of in an island, right? You're over here. But the beautiful thing is that you can really, really move things to benefit the client as opposed to the other way around. And so that's how a lot of people do go independent because they do get tired of the politics or the stringencies. I mean, all the other stuff. I mean, I can remember my days at. I'm dating myself now, but I was at Paine Webber. We used to call it the House of Paine, and that's before UBS took over and then got really painful. Not to, it was a culture change overnight. And so yeah,
Mm.
that's why I kind of started seeing that, if I want some continuation, I can't look to management, right? Because they're all kind of trying to upper management for their cues, right? And upper management is looking to the board, and the board is looking to the shareholders. Meanwhile, my relationship and my duties. So cutting
Yeah.
out a lot of this extra noise, I can hone in, and it's not learning.
Yeah. No, I can totally appreciate. I was just gonna say, like, you're touching on that I feel like the tension that exists, right, within the corporate world versus running your own business, and then there seems to be a little bit of like a conflict in terms of your value alignments versus theirs, or sort of the outcomes they were pushing for and what you were going for. So I'm curious, really, personally, what's your why? Like, in a sentence, what's your why for doing what you're doing?
I'm glad you asked. I can point it back to one day. I when I worked at Weber and UBS and all these other places, Wells Fargo, Union Bank, I was used to dealing with very, very ultra high net worth clientele. And what was great about that is you do get into the complexities of a lot of these estate planning cases. And so, the geek in me that kind of speaks to me. But as far as experience, what I found a lot is for some of these people, you will just want to be better, right? Your impact was sometimes negligible, right? It just happened to be idiosyncratic sometimes, how they felt that day, that week, that month. Um, but I remember I sat with this woman who had some pretty healthy savings, but she was very nervous. And so we inputted all the data, we ran through all the scenario analysis, we even went extra conservative on some of the assumptions. And I showed her, even, with all these Monte Carlo scenarios and whatnot, she could do it. She had it better than 95% on all scenarios, 100% in most of them. And she literally wept. And she thanked me because this was something that had been on her mind for some time. And I could tell she wanted to hug me, but we were in the fridge. But I remember I drove home and I felt happier than I had in some.
Hmm.
And that's the non-pecuniary reward of this job is that you do make an impact on people's life. They do appreciate with help because, no matter how much they know, there's so much thrown out there now, especially now with AI, all these different tools and all these different products. Just the financial services industry is not unlike any others, right? They need to keep your interest. They need to keep you peaked. So they're constantly reading what the financial and the market environment's like, what people are hungry for, and they're trying to devise a way to give it to them, right? So rather than help people, that actually inundates them more, right? Because wait, there's one more thing, and what is that? I mean, I've explained the difference between an open-end fund and exchange traded fund 4 or 5 times with some people, and there's still something missing in terms of them getting it because some of these esoteric and very abstracted financial engineering projects don't register. Like they're not like I get how stuff work but how does this work versus that, and why is it so different? And yeah, because you're throwing in a lot of like, different parts of this grand machine, they feel lost. They feel lost. I mean, look, I've got a charter and I'm a planner, and I sometimes hear about stuff like, wait, what is that? You run that by me again? And I know I have to hear it 2 or 3 times. I do this for a living. Forget the clients. Like if they have to hear this, and even if you're an engineer, there's a lot of industry jargon. There's a lot of so we're also not just a guide, we're a protector because, and I hate to say it, but if your advisor only has a Series 7, right? I now call it a Series 007. It's a license, right? It really is. It can be. That's not enough anymore. The landscape has changed. It is just. I mean, when I got my Series 7 in the '90s, applications were one page, right? Top third was their information. Middle was their risk tolerance and then investment time horizon and all that stuff. Then we have the disclosures, signatures, and triplicate the problem. That's it. Then 9/11 happened. The USA Patriot Act happened. Now we need to know everything, where this money comes from, where do you live, where do you bank, all this other stuff. And so it's just become now, it's just become so varied, and there's so many different other companies. But yeah, unless they even have like IAF or something like that to show that they are starting to niche themselves in a certain corner, they're too much of a generalist, I think, to really understand just all the dangers.
Got you. So really, if I was to play this back, your why, it's about really looking out for that other person and delivering that impact on a personal level. And then you layer in the complexity of how things have evolved over the last few years, if not decades, along with all the macroeconomic, political, variables that get thrown in the mix. And then, the amount of news that is then thrown, whether real or not, it just adds more and more to that fear component, where for you it's like, well, that's where you can sort of come in and not just do what you need to do to on the money sense or the financial advisory sense, but also just sort of educate them a little bit and then equip them with the skills to sort of handle all the quote unquote stuff that's coming onto them.
Exactly. And like I said, since things are getting more and more complex every year, there's a reason that people with 40, 50, even 100 million still have it right? To a lot of people, like, if you have that much money, don't you have enough? Like, well, it all depends on the goal, right? Some of these guys have to feed a generation. But they still rely on advisors. Why? Because we need to see the tax codes changing, right? We had the One Big Beautiful Bill Act, which changed a lot of things, right? Sunsets in and will soon sunset out other things. The new financial engineering products that are being offered, I want to say every now 8 months, there's something new on the horizon, right? Like now, I mean, so RILAs got really big about 12, 13 years ago. They started. And for those that don't know, RILA stands for Registered Index Linked Annuity. And so MetLife was one of the first people on, and they had the Shield product that now Brighthouse has. And it was a point-to-point, follow the S&P, right? And if with a 6-year period, it was down, they would cover those 10, 15, or 25% of losses, right? And adjust the cap supporting them. So throw in that we've only had one down year since 2009, right? Even 2020 was a blip. These became more and more popular. Now they offer them with stuff like, okay, at the end of the 6-year period, we have 3 different portfolios. We'll credit you the one that performed the best. Or we have 3 different indices. We'll weight it so you get the best possible return. So now you don't have to rely on forecasting as much, which is the hardest part of the job, right? Because again, like I mentioned before, 2022, both stocks and bonds were going down. The 60-40 mix was thrown out the window the first time since I think since 1934. And so what happened? Everybody's waiting for that recession. Every recession, even Goldman Sachs, about a 50-60% recession. And then the AI momentum, right? I don't want to use the term bubble, but you know, came in and that changed it, right? And that started dragging the market up. And you know, people are human, but this is one of the things that and as humans, we tend to gravitate to the crowd, right? We tend to get that information, right, to know how to adjust our behavior. The problem is that when it comes to investing, especially after such a long period of time in the bull market, the crowd could be the worst example to follow. Warren Buffett, there's many clips that everybody loves quoting. One of the most famous ones is be fearful when others are greedy. Be greedy when others are fearful. Greed is really still ramping up. I don't see as much. And then when you consider that the top 20% of us are holding up the economy, and the economy decoupled from the market back in 2020, right? Because we were in a recession, we were all home, right? Very little economic activity. That's why when you look at the economic data, savings for most people is skyrocketed during that time. But what else went up? Everything. The stock market. All right. Bonds went up because yields went down because people were buying them. They were still nervous. Non-fungible tokens, Bitcoin, all this stuff. It was tradable, it went up. So that gave us a great idea that, you know, the Fed opened up the spigots, all the water rushed in. A lot of that's still in there, right? And so now you have people that are kind of a little concerned, like, you know, is this smoke and mirrors, right? AI, how even though they have free cash flow, are they really profitable, right? Because adoptions take time, right? So this is where it's harder now to be an advisor, I think, than ever before, simply because the anxiety is higher than it has been in a long time. Right? Between the geopolitical risks, you know, the specific risks of the U.S., what AI will do, what the impact's going to be. I mean, everybody knows it's going to get smart enough to take over all our jobs, right? But the question becomes then, right, what's going to happen to us? And so, yeah, I mean, I get a lot of questions.
I was actually going to say, you know, you're mentioning, I think, very rightfully so, that the anxiety, the trust, you know, is at an all-time high. And it made me sort of just reflect, you know, you've been in the space for a while. You lived through the dot-com bust, the 2008, the 2020 to 2023 volatility cycle. You've lived through a lot. Each cycle was something else that triggered it. What did each cycle teach you about risk and client behavior, especially from the lens that now you're looking a little bit, you're seeing that anxiety come play? What are some previous learnings that you're seeing that, you know, started to come through here or sort of helping you equip, you know, in handling this?
Thank you. It's a great question. The first one I learned is that the longer a bull market happens, the shorter the memories of investors get. They forget that, hey, you know, we had 3 down years in the S&P from 2000, 2001, 2002, but they know. Everybody else is going, I want to go too, right? I mean, the people that bought houses in, you know, fall of 2006, July, January 2007, because, again, they feel safer with the crowd. But kind of negotiating that tension of knowing when the crowd is not your friend and knowing when to adjust, not just to, you know, maintain your portfolio and whatnot, but to make sure that your return patterns fall in line with your expectations, right, of the market, of what the goal is. I have that conversation with people all the time. You know, they say, now, how much should I put in the market? And there's so many rule of thumbs, right? Schiller has your age minus 100 is how much you should put in stocks. It's a nice rule of thumb to start off with. I'm a big believer in need, right? We figure out what you have, we figure out the passive income, we figure out the shortfall, then we figure out how much that shortfall needs to grow by on an annual basis to keep up with inflation, right? To make sure that you can pay all your bills in year 30 that you can in year 1. Right. So, if someone has a very high threshold, they didn't save as much, so they need a bigger return, like 7%. Now we have to use some risk, right? You have to definitely need equities or other investments to help bring up that yield. Some people have so much cash and they have pensions and Social Security. Like, hey, as long as you outperform inflation, and you can do that with bonds right now, yields are still historically high, at least in the last 20 years. So that's what I've learned. That people tend to weight all that financial information too much and think, how does it affect me? Right. And I like to play this game with people because we tend to think that we have to make a move because everybody else is moving. So one of the things I asked them is,
Mm.
imagine if you could, you're driving in your house every day, and in your garage, there is a giant readout of what your house is worth, right? Based on comparables, all the other stuff, right? And of course, you see it kind of trend up. Some days it goes down, but it's trending up, right? Now imagine that for the next 2 weeks, every day between them, it gets trending up. Right? How long before you start asking yourself questions like, does something happen in the neighborhood? Is there a sinkhole? Should I move? Should I sell? Right? Now, what changed in your plan? Did you, I mean, if I sit these people down, like, do you still plan on retiring in another 15 years? Yes. Do you plan on moving? Well, no, until I heard this. Okay, so the only difference was this new information about a temporary trending prices. If but for that, you wouldn't have made any changes whatsoever. You wouldn't be asking yourself that. And so that's the problem. They feel I have to do something with this information. Right? So no, you
Mm.
don't. Not always, right? Not always. Especially depends on how longitudinally you view it.
That's fascinating. That's fascinating. So, one piece is, crowd gives comfort, but you got to have judgment on when to trust the crowd. And then the second is each information, as overly stimulating as it may be, as overly overwhelming as it may be, doesn't necessarily require your mental bandwidth to do anything with it, naturally, depending on the type of knowledge. But that's the filter that, or I guess that's the muscle you've developed with the years of experience that you've got witnessing these different things along your way.
Yeah, I mean, it's. I try to remind them that one of the reasons that we're still working together is that we're trying to tamp down their anxieties, and that wondering whether or not things should get done just because it was in the news just leads to more anxiety. Right now, you're wondering whether I should make a decision, and everyone's always kind of overwhelmed by decisions when it comes to how I should arrange my portfolio. Right? I mean, so many people in between the performance of the market in the last 30 years, and some of them have pensions that have real nice lump sum payouts. So between the two of them, they're sitting on $2-3 million. They don't know what to do. It's not like they took a systematic approach, did their research, rebalanced their portfolios, and put more S&P, more bonds, depending. No, they let it grow. They saw that it was going up. Now they're at retirement. I'm sitting on this. I'm not really sure how it worked. I'm not really sure how it happened. But now I don't want to lose it. Right? I want this to be my base. And so that's where you have to start showing people that what gets in there is not necessarily what gets in there, and that it needs change. One thing we talk about is they have to stop thinking about the market and start thinking in terms of stuff like long-term care. Right? 1 in 4 of us is going to need it by the time, especially now that we're living longer and longer and longer. I use Michael J. Fox as an example. Right? People think that's going to happen when I'm 60, 70. But who knows when Parkinson's could hit, right? And luckily, Michael J. Fox was wealthy. What's going to happen, right? And it's amazing when you start walking people through scenarios of how unprepared they are for that. I was speaking to each other, and I just
Mm.
asked him, what would you do if something happened? And he told me, well, my daughter-in-law would help. I said, okay, is she working? Yes, she is. Okay, who's going to replace that income? They hadn't thought of that. So when you start working through, it's like, okay, crap, this is something you have to think about, right? So, but I find that once they understand why they're in what they're in, right? Because again, gone are the days where an advisor just says, trust me, I've got you. That's not enough, right? Then that gives them the resilience. And that you, counterintuitively, you think, well, you're making them a bit more independent. They're not going to need you. No, they associate that independence with you, right? And they also know that since you're at the forefront of it, since you are looking at it, they are counting on you to let them know if changes need to be made, right? Because if they're looking at it, they're not enjoying the time. That's the thing. The more they have to kick the tires and inspect the car, the more they're not driving it. And I remind them that this is our job, like they're mechanics, so they can do
Mm. I was going to say it's clear that your edge here isn't about chasing the alpha at any cost, right? It's about aligning that strategy with, I mean, it might be more appropriately phrased, aligning strategy with human psychology, really, or sometimes realigning
that.
that, right? For folks that sort of get
Oh,
carried, yeah. And so if we bring that lens to amenity wealth today, right? And I'd like to get a little bit into, because you started to share about some of the cool things you've heard and how it's been impactful, or some of the tough conversations you've had to be able to help your clients sort of uncover what's important. I'd like to bring the lens now to amenity wealth today in terms of what's working, where do bottlenecks show up, and how you scale, especially when you've got this element of the human touch. So, starting from the beginning,
definitely.
curious, where's amenity wealth today in terms of, I guess overall, where's amenity wealth today? If you were to give us like an overview of what that looks like, and then we can start to get a little deeper into
Well,
it.
okay, so we just finished our third year and we've grown every year, so I'm happy about that. When you mentioned bottlenecks, the immediate that popped in my head is operationally, there are always a lot of bottlenecks in this industry. And one of the reasons is because in trying to give flexibility, um, it's very difficult to find a one-stop shop, right? So,
Mm,
for example, we use SCI for our advisory because the team has, in my opinion, a really good history of doing the research to make sure that their high conviction asset managers do follow through. They're either beating the benchmarks or delivering similar returns with much lower risk. Right, this is why they're there, right? Um, and then we use, if we use annuities, with the insurance, right, department, of the insurance carrier of it. And if they have brokerage, which a lot of our clients do, if they work for Bowen or SoCal Gas, a lot of times they want to keep that. Well, I'm not going to feed them on a static stock portfolio, so we hold it for them. So now we got 3 stepping up. And even though they're under one umbrella, they don't communicate very well. They're like, I don't know, Warren siblings sometimes. So it amazes me that myself and my associate, about 20% of the time is clearing up operational inefficiencies that unfortunately are persistent because there's only so much we can do out here. We can't force them to adopt technological standards, right? So I'm amazed that sometimes we're still emailing forms and that, and I don't get it. One place actually has fax. It took me a while to fax, right? It's amazing how the facts went from cutting edge to yesterday's news in a 30-year period, right? So that's the only thing that is in our way. Now, on the positive end, I will say Jose is making real strides in trying to coalesce this stuff. We now are with the new OSJ, NWF Advisory, which they really streamlined the process as well. So I've been pretty happy that I have seen a lot of improvements, right? Um, but
mm,
we're continuing going and we're getting referrals from existing clientele, which I love. It just shows, I mean, there's no greater sense of accomplishment than that you're doing a good job when someone says, hey, you know what? You should talk to them like that. That's the silly people. And that, again, because we do deal with the touchy feely side of this, yeah, that's very rewarding. And so that part isn't going to change. In fact, uh, as counterintuitive as it is, AI is helping in that. What I tell people is, okay, places like Capital Group, they built their entire reputation on the fact that they have done a great job of outperforming their benchmarks. One of their secret sauces is they get about 80 to 90% of the upside, only about 60% of the downside. If you do the math, you can actually outperform the market because losses are a lot harder to come out from under, right? So their loss mitigation strategies really work. An algorithm's going to figure that out, right? Or a few algorithms. So figure you get that plus trading strategies, they're going to erode away, or as they say in our term, arbitrage away that excess, right? And then on the other hand, you now have companies like KKR, Carlyle Group, big private equity firms. And they're going up to places like some of the best names in the Russell 2000 and saying, you know what, why don't we really try this out here? And there's several reasons why companies would say yes, right? I mean, we no longer have this quarterly monkey on the back that if we didn't hit a project, we better have a darn good narrative why and why we're going to hit it next time. But also, let's talk about this. Unvested stock options get immediately vested. And so often management gets a windfall. I experienced this when I worked at Union Bank and the Japanese reprivatized us in 2008. Years later, I found out they were warring off there was a hostile takeover. US
Mm,
Bank was trying to encroach. I think US Bank was the one trying to do the hostile takeover. But yeah, the stock went from 17 to 22 like overnight. And then what was interesting is that even though the stock had never traded above 50, the Japanese offered a tender offer of 73.50 a share. This is 2008. Everybody, take my shares, right? Because all my other portfolios doing horribly. When you're paying that kind of alpha on book value, oh yeah, suddenly Union Bank became a Japanese company, and it was we want ROI right away, and that's when we started saying,
yeah.
okay, I need to go independent because all this was out of our control. I mean, outside of the fear of what was going on in 2008, none of the situation of my clients have changed. But yet now, because the situation on the company had changed, I now am balancing what they want versus what the clients need. And that's what I thought, yeah, you know what, this is more excess energy that is better spent either going up the upper echelon or getting close to the client. And I chose the
Hmm. Yeah, no, I totally get that. That's fascinating. If we were to start a little bit on Amenity Wealth today, what would you say is sort of like the mix in terms of the clients that you got, the services you provide, and the growth
right?
cadence?
Well, 70% of the world's wealth is still controlled by people over 60. So we do have a lot of retirees, pre-retirees. We are starting to get a lot of their children and their nieces and nephews that are in different stages of life. One is as young as in the 20s, and she wanted some help as far as how should I be putting money away, and should I do the Roth 401k, right? So educating them, and then some that are first time home purchase or they just had their first child, right? So the insurance needs there, their planning needs there. So it's starting to run the gamut. We're really trying to make an impact in the community. So, interesting story. I'm in Bixby Knolls, which is the northern part of Long Beach. Um, I didn't choose this because I love Long Beach. The way it worked out, I love Long Beach, but it's not. I didn't choose it because of that. I was working in Lakewood, which is 3 miles, exactly 3 miles from this office and the branch that I had. So that's why I had the majority of my clientele from Maryland and Bowen because the C17 project is right there. So I thought I'm going to make it easier for them. I'm going to get a place that's right near the branch. So if they need to visit me, I'm a hot stick in the shop. And it worked well. And I thought I'd only be here a couple of years. Well, everybody's so friendly. And I got to know that CPA, and we're referring to each other now. And I got to know that attorney, and we're referring to each other now. And now it's a lot more easier to get into work mode when I get here. So we are trying. So because of that, I'd like to make more forays into the community. That being said, we've been
Right.
getting a lot of referrals outside state. So I don't know how it's going to work. Right? It's,
Yeah, 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 yeah.
3 years from now, I could be. Yeah, I'm in my home office. I didn't need the office anymore. I don't know, but I don't
Yeah.
see myself. Listen, we all worked from home right during lockdown. The only thing I liked about it is for the first few weeks, I felt like Hugh Hefner working in my bathrobe. After that, it just got dull, at least for me. So I like going to the office. I like the office is a 14-minute drive. It's a different neighborhood, but I'm now in work mode versus at home.
Yeah.
Yeah, I'll watch TV while I'm eating lunch. Next thing, oh, I took an hour and a half for lunch. I guess I watched the whole movie, right? That kind of thing.
Whoops.
Exactly. Let me go. I'll
That,
it
yeah.
too. Yeah, that's not.
Yeah. Yeah, no, I can totally appreciate, right? Because when it comes down to productivity, and if we think about it, be it on a personal level, business level, some folks are all about space and having that separation. Others are about, hey, look, this actually works out. I get the flexibility. I got to do a little bit of this and that. And so it's always fascinating for me to always hear with all the conversations I've had, everyone's got their way of what works out for them.
Nice.
And so it's great that you've managed to find like that community, and naturally it's all very consistent with that element of the way you put it, bedside manners, right? The human first sort of perspective. So if communities first, it makes sense. It makes sense as to why you position yourself the way you did. And so if we go a little further and think about, for you today, Amenity Wealth, how you track its success, and naturally community, the soft touches, these are all very critical pieces that you very eloquently sort of shared. On the more quantified side, what are some core numbers that matter most to you right now when you track the health of your business, Amenity Wealth and whatnot, client retention, new qualified intros, referrals, whatever it may be?
Right. Um, it's funny. I'm glad you asked that. So we always have to look at the bottom line, right? Where did our revenue go versus last year, right? This quarter last year versus this year. So we do look at that bottom line. I start to notice also. I look at where they got allocated. Did more go to advisory? Did more go to brokerage? Did more go to insurance? Right? Was that kind of just lucky? Right? Um, now you need to do the metrics and see what the average return per client is, all that. But we also segment the book, not just A, B, and C clients, but also a separate tack, a separate class, if you will, for people that are in the community that are it's two certain centers of influence, right? That can help us kind of know it more and more because as I came to work here and as I see it, I mean, some of these people have been here 10, 20 years and they all know each other, know each other's families and everything. I'm getting to know that, but I'm still kind of new. I've only been here 3 years. So like I said, first revenue, right? Then kind of the stratification of where that came from, right? And then of course, the per client profit. But then of course, where are we going to start farming, right? And where are we going to start harvesting new people that know, yes, we're in the community, we're part of the community. We do reach out and we do actually try to engage with them as much. And Between Olds every quarter has a local get together where they bring in food trucks, serve breakfast, and everybody gets to know everybody. And so,
Mm,
ventures going on, new things going on in this part of Long Beach. So, stuff like that just takes time. So I'm grateful that we already
yeah.
have a critical mass of clients that, we're an ongoing concern. I'm not worried about like how we can keep the lights on. You got the lights on, they're going to stay on. But is the real big question now is, yeah, there is a bifurcation where we're getting a lot of referrals. We got one from West Virginia, right? I it's a physicist. It was amazing. And then I just thought like, well, West Virginia, like, and then of course trying to keep it local. So I really can't say. I'm a big believer in I've got to go with the flow with this, and so whatever ends up happening happens. Um, what the other thing we're doing is we were about to bring on another advisor. Last, I think he decided that he wanted to what just stay insurance because he had actually had this. He still had his security license, but it was going to sunset out. And I thought, come here, we can do this. You can keep your insurance separate. And he was going to do it, but he thought, you're reminding me why all this onboarding and all this stuff reminded me why I left FINRA in the first place. I think I'll just deal with insurance, which I mean, I think it's, pick your poison, but I guess you found arsenic tasty, I guess. I don't know.
Yeah. That's incredible. So really what you're saying is, if I'm hearing you right, that you've got, I mean, bare basics, you've got that locked down. When we think about the future and the strategy, what's coming next for Amenity Wealth, there's an interesting question on the horizon for you, whether it's continue to stay local or entertain, out of state business, so to
I mean,
speak.
what will entertain is, I mean, I spoke with the gentleman, we're still in contact, and if he decides to move forward, then I'll get licensed, right? And then, that's kind of how it goes, right? Before he signs any paperwork, I need to make sure that I'm registered both in the FINRA and, of course, with the State Department of Insurance in West Virginia. But,
Mm,
we got a couple more referrals today. I mean, one is from Arizona, one is local. So, like I said, it's I got to go where the flow goes. Um, so I don't
yeah.
know what it's going to be like, but I'm kind of hoping because again, I really like it there. And I could always just stay, but if let's say it gets to a point where half our clients are out and half our clients are, then it becomes an economic.
For
For the
sure, for
world.
sure. Yeah, yeah. And I was gonna say, I mean, given how much of a focus you shared on having like that in-person piece, within the community, how are you getting that traction from out of state? What are you doing today to be able to drive that traction towards
A
them as
lot of
well?
referrals, we were using LinkedIn actually. So some of this was when I
Mm,
started, I had gotten what some uh, involved with some company that they had a software system that you can actually, reach out, start conversation with people, and then if they bite, then you can, continue and take it off the phone.
amazing.
And so that's how. And at first, I kept it local. I kept it to this area code and the surrounding one. And while there are a lot of people, of course, the bigger your net, the much, the more fish you catch. So I hate using that term, but and so as I opened it up, yeah, we started getting people from New York. I'm licensed in New York, Florida, of course, but West Virginia was kind of thing off. And so that's why, and it will really just be a function of how soon they onboard versus how soon they don't, right? I mean, there are a lot of people that I see here locally that still haven't become clients, and there are some people that aren't local that become clients after the second or third meeting, right? So that's
Yeah,
so while that
that makes
loves keep it
sense.
local. I'm not gonna buck the trend. Whatever the trend takes me is where.
Yeah. That's interesting. That's very cool. I was gonna say I can appreciate the anchoring on where going with the flow because you're right. Like you don't know what you don't know until you know, and why not make sort of go with that. If we were to now flip the conversation a little bit on its head and sort of go back to something you mentioned on operational inefficiency, you share that you and your associate spent roughly 20% of your time dealing in just clarifying communication between the different sort of entities or the bodies, if
Right.
you will. Where else do you find most of the bottlenecks today in your current operations? And you can, we're all the way from the beginning, let's say prospecting, qualifying leads, onboarding, and then, whatever it may be in terms of execution and beyond.
So prospecting is always going to be the wild, wild west, right? Because you don't really know. I mean, what I found is that the wildly successful financial advisory firms, right, like mine, the wealth management firms, generally fall into three buckets. Number one, those that, as Buffett puts it, won the genetic lottery, right? They were born to a wealthy family, daddy and mommy were well connected. They're not starting zero, right? Then the third people are marketing. I mean, second group, marketing sheep. I mean, it's just go, go, go. They've got their process down to science. Are the clients, now they're giving you a wide distribution of clients. If you have too rigid of a system, then you are fitting square pegs in round holes there, right? So that's one of the issues there. And I wasn't born wealthy, and I don't believe, yes, you need to have a process, but it can't be that rigid, right? Um, and the third group, which is what we're doing now, is we're finding what works and we're doing it together, right? So I know guys that do seminars. We've done seminars. I like seminars, but there's so much leading to them. Gone are the days where you would have it at your office. No, now they want them in libraries or universities, right, to give more of the veneer of education, which makes sense, right? Because the brain is an associative right, instrument. So I'm all for that, but you've got to schedule that. They want like a Tuesday and a Thursday, right? So you got to make sure that's open. You have to get insurance for these things. And it's roughly only about 75 to 85 bucks a time. But yeah, they want insurance. And so anyway, having it, they also want a copy of that. Then of course it's getting the people in, confirming them. Then you deliver the seminar. Now after all that, something in your mind goes, oh, it's done. No, it's not. Here's where it starts because seminars are all about the follow-up. They're all about the follow-up. And if you don't follow up, you waste it all the time. So while we did well with them, my associate was brand new at the time, so he didn't know. So I did all the heavy lifting. Yeah, I'm still kind of burnt out on it. So that's why I thought, you know what, LinkedIn, I can sit here and type. I can be at home in my, bathrobe and type, right? So right. So as far as prospecting, that would be a bottleneck there, right? But
Yeah.
and the only other one would be because there are different systems that don't coalesce very well. That I don't see that changing simply because, I mean, if you think about it, I'll give you an example. FINRA has had their rules as far as what's necessary in establishing anybody's ability to or rather the compliance aspect of it, make sure that you are giving the right and proper investment to this person, right? And this is why we ask for risk tolerance, time horizon, investment experience, right? And of course, name, social security. All these are standard. So it would take nothing to say standardize these intra-system. That way, inter-system could communicate. So let's say I wanted to leave LPL and go to OSA. Why should I repay her? Joe Schmo over here is still Joe Schmo over here. Did anything change? No. Has it been more than 2 years? No. Then why are we having to repay her? We're doing it because it's a barrier to entry. We know most reps will not leave because that's a big pain and you're liable to lose people, right? Like, I don't want to go to, right? Or I don't want to go to Jose, right? So who does it benefit? It benefits the broker dealers, right? So these inefficiencies are now ramped up, and it amazes me in the 21st century. And I see them most with the small insurance companies. You know, some that will remain nameless, but for example, their initials are Oxford Insurance. Places that, for example, don't need any ID to open up the account will take the money right away. Oh, you need money? We need ID. We need 2 signatures on the same form. Oh, and you're married? We need a signature from your spouse. Meanwhile, they didn't need a signature to get that in. That's disingenuous. That's bad practice, right? They see what you're doing. And why are they doing this? Well, when interest rates were 0 or near 0, they made money on a transaction. So people used to overnight at their own expense, right? Because the transaction, they're going to make the money back on inside. Now, they're getting interest costs. So yeah, a lot of them playing the float. And we're an insurance company that, let's hit with RILAs, especially with fixed annuities, these are all in the general account, right? Every day that it's in there, I'm making money off of it. So yeah, the very last, one of my best clients, the very last contract I had with the insurance company I named, they had 30 days. They took 30 days. And during that time, she's making 3% because they ratchet it down, right? And of course, you know, you can yell, you can scream, you can beg, you can plead. They don't care. This is their business model. And so inefficiencies will always be part of this business because, again, you have to ask pro bono, who benefits from it.
Yeah. Yeah, no, I get that. I appreciate your candid transparency in this. So I'm curious. I mean, you've mentioned a few different areas of the bottlenecks here. Having a previous conversation with someone else, they described this as what is your hair on fire bottleneck, and the way they really describe it is like your hair's on fire. You will even use whatever you can to put it out. So the question I've got for you is, if you had a magic wand to fix one thing that's slowing you down, that hair on fire problem that's slowing you down, what would that be?
Getting rid of Persian. Completely. And I'm not kidding. They still do business like it's the 20th century. It is amazing. SCI, the ones we deal with on advisory, they are now offering brokerage solutions, and we're looking and moving everything on mesh, where we don't have to charge them anything. If they do need to do a transaction, then they have to get feed, but the platform fee is I think 30 basis points or 25 basis points. Similar to the 12B1 fee, so it's not killing it. And I think it's worth it. It really is worth it because that's usually where I have paid for so many wires and so many overnight checks because we don't know what happened. And it's popular, and you'll never get the same person twice. And even if they make a mistake, there's no, and I'm going to say it, accountability. It is horrendous. And they don't care because they've got I don't know how many trillions in assets under management. So apparently they're not big enough to make that kind of impact. But I know from speaking to other people that it's not personal. It's just how we do it. So yeah, and I think that also speaks to the brokerage industry in general, because advisory, they know, listen, people are coming here, so we're going to try to make things as 21st century as possible. Insurance companies, we're starting to get that. So people like Pac Life has an excellent website. Their website is like a TAMP, a third party asset management platform. I can add new payees, change bank accounts, do withdrawals, all that stuff. And if they need to sign it, DocuSign right through there. Or, the other insurance companies, like, we know this is the 17th time that they're taking out of this annuity, and we know it's going to the same bank account, but since we don't have a voided check on file, we're going to have to send it regular mail. Oh, we need them to sign that they need the money because, yeah, we just don't trust the other 16 times. And again, they are incentivized because slowing down the process benefits them. So, yeah, but yeah,
Yeah.
brokerage is falling way behind, I think, across the board, not just with Pershing, but with NWF, all the other ones. I hear reps always complain because I think they thought that was the default for everything was brokerage, right? Now it's not. The other places became more competitive to win over advisors, and brokerage is left hand in the bag. They're like now like, oh, left behind, right? And I don't feel sorry for them. No,
No, that's
they were
fair
warned.
enough. I was gonna say the magic wand you waved, it sounds like more of a systemic problem that you sort of have to deal with. Is that sort of a fair summary of that?
Systemic in and of it, only in the sense that there are certain things that need to happen when something gets categorized from brokerage into advisory or brokerage into insurance. Yes, and that will always be a bottleneck. However, uh, some places are better than others in dealing with it, and the more processes you have in place, because everything was done on an ad hoc fashion, there you can guess that okay, they never went back and redid the infrastructure to streamline these processes. Right? They added,
Yeah,
and
I
so it's
got you.
terrible that if you think about it, and I remind people this, like taxation, there's no grand unified field theory of taxation, right? Every time there's a new president, there's a new idea. I'm going to change the economy, and so the laws change, right? As far as Congress okays them, and so that's when you can really tell when a system has been optimized versus a system just kind of adjusted. And oh my goodness, most
Right.
brokerages, because they have several different workflows. When I was at QSO before this, which is Credit Union Service Office, and they used well and InvestNet. This is how bad it was. You're a client. You need to take out $10,000 from your, I don't know, your capital group portfolio. Okay, so unless I had it on file, I needed to do two things. I needed to email you an either distribution form, Pershing. Then I had to go into InvestNet, raise cash. Then the next day I had to, what you call it, send the cash, or either to Pershing or out. And there might be a fourth form if you wanted it ACH or overnight. Four forms to do one $10,000 bill, right? That's why we went to the TAMPs, because the TAMPs like, what do you need? It's like, okay, and oh yeah, we have their address on file. How do you want it? Click this radio button. It's all go, go, go. So something that took 2 days of four different tasks because I had to wait for settlement is now done inside of 2 minutes. And right, and if
Yeah.
something goes wrong, I'll get an email or a call from them saying, "Hey, this didn't go through with X, Y, and Z." So yeah, this is the problem that I think brokerage has had. They just because
Yeah.
they didn't feel they needed to. Yeah.
Got you. This is helpful. No, I mean I appreciate you sharing like a systemic problem that you're still navigating in, and it's even more interesting given the advancements in technology and AI and all that, that the gap of being left behind seems to just get even more magnified and amplified with that. If we flip the lens here now, I'm curious. You've got a lean team, right? You and yourself an associate, and so you've got you're year over year you're growing. I'm curious if we were to take a forward-looking approach, what is on the horizon for you in the next 6 to 12 months that you're working
Okay,
towards?
that's a good question. So like I said, moving version is one of them. Uh, the other one is I'm we're gonna license my associate, and this way, because I have been talking to other advisors about joining the team, right? Because that's a quick way to attention. And I'll have to see whether he wants to sit in my seat, my associate, or somebody else will part time. Because in the next year to year and a half, once we hit a certain critical mass, I am going to spend most of my time outside in business development and brand awareness. Um, I mean, I enjoy public speaking. It was just all the lead up and all the preparation, all that. I mean, if there were a company that said, we'll do it all, you come speak and then you can do the follow up, how much, right? That would be a dream for me. But there are other ways to go about it, and that's where we would go after that. I mean, in the interim, we're just always trying to optimize the change from the Americas Group to NWF, which is our OSJ, our Office of Supervisory Jurisdiction. That wasn't our choice. Ameriflex was going full RIA, which is Registered Investment Advisor. Since we still have some brokerage, it wasn't a good fit anymore. So luckily, we were able to find another one, and we were able to do what was called negative consent letters, right? Where we're just letting people know we're switching over. Well, what's funny is that SEI really wants to take an extra step to make sure everything's okay. So it slowed down the process a bit, right? So we're still kind of ramping up from there because these things really do stymie momentum. They really do, right? I mean, you have to stop, redirect, and refocus, right? So I know I took a very circuitous route, but to answer your question, the growth is going to continue, but I think it's going to ramp up because I think one or two of them are going to join up on there. And what's great is that since things don't need to be centralized, these people can work from their home.
Thank you for your time. I think you've taken the time to. What I really appreciated is the transparency and the honesty of how you've sort of shared this. And I can only imagine what it's like to be on the other end of the table with you being the advisor of, you sharing the spirit. So with this, I'd like to, I know time's of the essence. I'd like to sort of bring us towards the end of the episode. Today, for our audience, we heard how Boris built Amenity Wealth, and we all appreciate, your why, where it's around the clients and blending your deep credentials, practical experience, the cycles you've witnessed and sort of learned from, and frankly, a very psychologically driven approach where it's around the human touch. Right. I think thank you. I think it's very cool to see a thoughtful team, a very lean team that wants to scale while having the human touch be front and center. Boris, thank you. Is there any last words you'd like to share?
No, I really want to say thank you for the opportunity to kind of get our message out there and to let people know that if they need a consultation, feel free to reach out. AmenityWealth.com.
Amazing. AmenityWealth.com, that is, folks. That brings us to the end of this episode. This podcast is sponsored by Algo AI Partners. We help fintech services and companies scale using smart AI solutions. If you want to book a free consultation, to find out more, click the link in the description below. Drop in a comment, throw in a like, and hit subscribe. Thank you.